Hello, everyone, and welcome back. My name is Andrew, and you're watching The Night Shift. Look, I've been very openly bullish about CRNT stock, and depending on where you entered over the past 2 years, you're either rather pleased with the nearly 50% gain from the $1.81 to $2 range entry about here, or very disappointed with the about 40% drop from the range when it was, in about this $5 area. I've taken some time to evaluate their most recent earnings. With the decrease in revenue year over year, the decreasing sequential North American revenue mix, and a drop in profitability we saw with the most recent quarter, along with the rise in the stock price up to $3, I think it's time to ask a very difficult question. Is it time to sell Ceragon? Before we dissect these numbers and look at the actual diagnosis of the business, do me one massive favor. Please just hit that thumbs up button. Give me a like for all of the hard work we put in here on the night shift. If you really like what we do here, you should subscribe so you don't miss out on any future content. Also, if you want to see how I'm maneuvering this market and all of the volatility in real time, I share all of my personal stock and options trades daily inside of our private Discord. So join my private group of dedicated investors in the Patreon community. The link is going to be in the description below. So now let's look past the surface symptoms. If you just glance at the raw numbers from the past quarter, it looks ugly. But today, we're going to debunk the bear case and show why the three scariest metrics on the chart are actually incredibly misleading KPIs. So first, let's address the headline scare. Revenue came in at $85 million, which was down 4% year over year. In general, you definitely don't want to be owning a company that has revenue going down. But the bears are painting this as a legacy hardware company losing its grip. I want to kind of emphasize what actually happened. Wall Street was only expecting 80.3 million, and Ceragon beat those expectations by about 5%, reaching the 85 million. More importantly, though, look at how they're generating value now. The old bear thesis was that this company is entirely chained to lumpy, unpredictable hardware cycles. They are systematically changing the game. They are actively winning major contracts for their proprietary network digital twin. For those who don't know, this is software that creates a real-time digital replica of a physical telecom network to self-optimize and predict failures before they happen. This is not a one-time sale. It is a high-margin and sticky software recurring model. Combined with management completely reiterating their full-year guidance of $355 million to $385 million, the revenue trajectory is becoming structurally. The revenue trajectory is becoming structurally more stable and predictable than it has ever been. All right. Our second metric causing panic is the sequential dip in the North American revenue mix. This one actually bothered me personally, but people are looking at the drop and assuming demand in the West was drying up. This is where looking at the macro environment and really evaluating everything changes the whole diagnosis. The dip isn't a demand issue. It is a temporary logistics bottleneck. We are dealing with intense ongoing geopolitical drama around global shipping lanes like the Strait of Hormuz, which has thrown a massive wrench into global freight. Combine that with a temporary export licensing slowdown on a specific semiconductor component that is included in their products, and shipments makes shipments destined for a major Tier 1 U.S. carrier delayed. They got pushed back. We do have a silver lining, though. While those North American shipments are delayed into the second half of the year, India picked up the slack. Ceragon booked a staggering $86 million in orders year to date in India, driven heavily by their next-gen IP50EXA platform, which runs on their proprietary in-house Neptune chipset. The demand for their proprietary silicon is global, and the North American shortfall is just a timing delay, not a structural defect. With that, we're going to get into our third KPI, which a lot of people could interpret as the scariest symptom so far, especially for a company their size. The EPS dropped to 1 cent compared to 3 cents last year. At a casual glance, this says profitability is collapsing, but let's double check the actual vitals of the business. First, let's take a look at the gross margin. It actually improved to 36%, up from 33.5% year over year, and as you can see, it's been pretty steadily increasing actually. Just think about how massive this is. Even with supply chain friction and lower revenue numbers, they're keeping more profit on every dollar they bring in. Why? It's because the core thesis is playing out perfectly. The transition away from low-margin commodity hardware toward their proprietary Neptune chipset and software integrations means their structural profitability is drastically healthier. The net income line is temporarily suppressed by current drama, but the underlying business is running cleaner and more efficiently than it was a year ago. Alright, so up to this point, we've successfully diagnosed and debunked the 3 scary market headlines, and maybe even explained why we've seen an increase in the stock price since earnings. But let's take this a step further. In order to show you why I believe Ceragon is still a buy today, I want to show you my projections. Before we start, I really need to emphasize just how conservative this is, because these numbers assume zero growth after this fiscal year. Right now, Ceragon is being valued like a low-margin commodity hardware company. With the stock floating around $3, its market cap is roughly $260 million. When you map that against the midpoint of their reiterated guidance of $370 million, they are trading at a PS ratio of just 0.7 times. Think about that. Because of the historical challenges, this company trades incredibly cheap. But as those gross margins improve, and remember they already are and they have been, but as they scale predictable software licensing and increase the quality of their business, that 0.7 times multiple becomes completely unjustifiable. And as the street realizes this is a proprietary chip and software integration play, the multiple must expand. Let's run the exact projection math using only this year's $370 million revenue midpoint and see what happens when the market re-rates the stock. Alright, so first up is the bear case. If Ceragon re-rates to a modest 1.2 PS multiple, which is still pretty low for a hardware-software hybrid, the stock price jumps to about $4.90 per share. That is a 63% upside from current levels. For the base case, which is pretty much what I think is most likely to happen, they would reach a fair valuation of about 1.5 price to sales. As their proprietary Neptune silicon and digital twin software scale up, we are looking at a $6.38 stock price, and this is a massive 112% upside from today's price. And lastly, we have the bull case. This would happen if margins grow even more than we currently expect by successfully tilting their revenue mix heavily toward the high-margin software. This scenario uses a 2 times price-to-sales multiple, which implies a stock price of $8.50. This represents a staggering 138% change or return from today. Once again, I really need to stress this math does not require Ceragon to win a single new contract or make any more money than they have projected they will this year. These numbers can change pretty drastically if you consider any type of growth or even take the top end of their guidance. This is the raw power of multiple expansion driven by improving gross margins and predictable revenue streams. This is exactly why looking past the surface level symptoms are so critical. Now, I know you guys are thinking, Andrew, what if the market doesn't wake up to this value by the end of the year? And what if it takes longer than we expect? First up, if you did think that, great job. I'm proud of you. You're doing great. Second, don't worry, I got you. So that is a very fair question. And investing in turnarounds require patience. It's also really important to point out that this is a very small market cap company that gets little analyst coverage comparatively to like Amazon or AMD or other bigger companies. So that can really even that can also prolong our timeline. So in order to kind of balance that out, I took a look and said, what if the next 2 years they don't make any more money? And what kind of compound annual growth rate would we get from buying today, right? If they don't get any revenue growth, they keep it exactly the same for next year, but that margin just keeps increasing, so we get re-rated higher, right? So even in our most conservative scenario, re-rating to a 1.2 price to sales gives us a target of $4.90, like I said. From today's price, that would be like getting a 27.8% CAGR. That, for reference, that's about 3 times better than the S&P average. So I'm doing really good. When we move into the 1.5 times price to sale multiple, our 2-year CAGR turns into 45.8%. Again, 4.5 times better than the market. And if our bull case comes true with that $8.50 price target, we get a staggering 68.3% compound annual growth rate over the next 2 years. But with that out of the way, let's get back to my original question, which was, is it time to sell Ceragon Technologies or Ceragon Network? Now, I have bought consistently over the past 2 years, meaning I have shares ranging from $5 to $1.80. Yet, for me, the answer is clear. It's definitely not time to be selling yet. In fact, by buying Ceragon, even at the about $3 stock price that we see today, I believe it's still heavily depressed and misdiagnosed. Because the market has questions about its ability to execute, I think the risk-reward ratio is heavily skewed in our favor. I really hope you learned something from this video. If you haven't already, please do give me a thumbs up, and if you like deep dive content like this, subscribe to the channel. I do a ton of this. Don't forget to check the link in the Patreon below to join my private group of night shift investors. That's going to be it for this one. Keep a level head and always perform a thorough exam. I'll see you next time, and shifts over.